All right. Well, Aravind, if you're ready, I guess we'll just get going. It took us a while to get all the tech sorted here. I guess Twitter Spaces needs a little bit of time to iron it all out. But you ready to go?
Yeah, I'm good to go. Let's do it.
Oh, awesome. So just a quick lead in for everybody who doesn't know about InternDAO. It is a application-driven DAO where you must apply to join. Its main goal is to share alpha amongst its members and to have fun while we build the Web3 future together. So we've started a new speaker series where we get to pick the brains of some of the space's most brilliant minds. And today we have Aravind from Alameda. Um, I'm going to go ahead and let you give your own introduction, but the key is you only have 60 seconds to introduce yourself. So go.
All right, perfect. Thanks so much for having me, first of all. So I'm Aravind. I'm a trader at Alameda Research. Been here about 1 year. Prior to this, I've been in the crypto space since 2017. I worked as an option trader in Susquehanna before that. Got into crypto during the 2017 ICO boom. Been in the space since then, although I took like a 1.5 year gap in between to go do some data science work in San Francisco during the bear market. So yeah, I think that's pretty much my background.
And I think you did it with a little bit of time to spare, so thank you. The goal of today's Twitter Space is going to really make this engaging. We want to move quickly, and we have a lot of topics to go through. So I'm going to do our best to keep our back and forth to a minimum and really stay on topic here. So we have this split into three phases. The first phase here, you guys will notice some themes. So I'm just going to kick us off here, and these are questions that the DAO's put together for you. So one of the big questions was, given TradFi's correlations with crypto and how they've become stronger over recent months, and how the Fed's decisions have become more and more important to risk assets, are you finding it? Are you finding that it's getting more important to pay closer attention to non-crypto specific events? And how have you altered your trading methods? And what do you want to see for these correlations to break? Or is this the new normal for us?
Cool. So yeah, this is something we spend quite a bit of time thinking about, and I think there has been a couple of like paradigm and regime shifts recently. I think it actually probably started uh, from 2020 because a lot of the inflows were quite macro driven post COVID, and in any like major macro move, you start seeing crypto also move with a high beta to it. I think it's also true as the industry starts maturing. And the way I like to think about it is that uh, I guess Bitcoin went through some like narrative shifts from like medium of exchange, store of value, and so on. And now it's mostly trading like a leveraged stock. So if the stock market moves up, Bitcoin probably moves up more than that. And if the stock market moves down, Bitcoin moves down more than that. So I think for the majors, this is becoming increasingly true. And I think we probably reach a level of like adoption where it becomes like continuously true. For non-major crypto assets, like I guess your I guess yeah, anything below like the top few coins on like CoinGecko, CoinMarketCap, I think this is less true. Similar to how I guess like early stage VC investing is not really driven by the Fed's monetary policy or interest rates and stuff. So a lot of those, I think, even if on the short run they have some beta to the general macro environment, I think things like user adoption, developers coming in, unlocks, and all of that will like drive more of the price movements, especially on like a long time horizon. But yeah, we definitely like watch this more as part of our like models. We see what like the stock market is doing, and like us and like all other market makers that now have like a beta to the stock market.
And the high beta large caps that you think move more or less with macro, do you think it's a function of liquidity, or do you think it's a function of the institutional vehicles that allow them to gain access, or what do you think is the reason that these are trading differently from the rest of the market?
So I guess in the short term, if Bitcoin moves, everything else also has a beta to it, and I think it's probably driven by like why like we are where we are, which is from like 2020. Fed started printing a ton of money. Cantillon effect meant that they like bought bonds. Bond people had to like, I guess, diversify their portfolio and rebalance, so they bought equities. Equity investors wanted like more exposure, and they'd like made so much money on equities, so they started like buying crypto assets and stuff. So all of these had like a knock-on effect because there was so much like money in the system, and people were looking for like moving further up the risk curve. So that kind of like led to the correlations we saw in like early 2020. A lot of those correlations had like a lag in the sense that the crypto market only rallied quite strongly post some of like the equity rallies. But post that, I think everyone just incorporates that into their models. So it's part of like a market and industry getting more mature. Uh, once you start seeing these kind of stuff like once or twice, people start like building models on it. I remember even when we first started on like equities moves, we had like a couple of minutes to trade crypto on the back of that. And today, like there's like a couple of equity moves and like crypto moved almost instantly with a beta to it. So more than like anything else, it's now just that people's market making models incorporate this. So those moves happen like almost instantly now.
Interesting. And I'm actually going to take this second before we go any further because my co-host Total Mark just got in. For those who don't know him, he is one of InternDAO's analysts, and he's an ex-TradFi options degen. So Mark, welcome.
Thanks, man. I tried turning it on and off again, that worked. So always the way forward. Thanks. It's good to be here anyway, and good to chat to you, Aravind. Thanks for taking time out of your day.
Yeah, not at all. And yeah, thanks for chatting with me.
Perfect. So we were just talking about how the models are being updated, essentially becoming more institutionalized for crypto. So we're seeing high beta near instantaneously. Can you give us a sense, and I don't know how much of this you can or can't talk about, but what type of quantitative resources are you guys deploying at Alameda? Can you give us a sense for the tech stack? What's being used? Are we using natural language processing that's looking at the Fed minutes immediately, or like give us as much of a sneak peek as you can?
Cool. Yeah. So I guess like Alameda is a quant trading firm by nature. Most of Alameda's employees came from quant trading firms like Jane Street and Susquehanna. So quant strategies are bread and butter as well as like market making. The difference between like crypto exchanges and traditional exchanges is like there's a few in terms of tech stack. One, I guess, like crypto exchanges, like almost everything is free. I guess everything is actually free. In traditional exchanges, you pay for data, you pay for like a lot of stuff. In crypto exchanges, you have like equal access to everything and everything is free. The equal access is also important in the sense that compared to trading stocks or trading anything on the equities market, there's no concept of like co-locating or microwave towers to get your orders sent to exchanges faster and stuff. So a lot of the tech infrastructure that a traditional market making firm have, a crypto market maker does not need. Uh, Outside of that, in terms of like model building and stuff, we do stuff that most traditional quant hedge funds do. We don't really do any like natural language processing, mostly because we don't think there's a lot of like alpha in that. There's so much noise and like stuff that come out in crypto Twitter and stuff. Uh, but yeah, we use machine learning strategies. We have like lots of like sophisticated models. We like scrape data from like many different exchanges, and yeah, I guess very similar setup to like some of like the top tier market making firms like Jane Street.
Can I just jump in there, Matt? I was just wondering, like, do you think there's any sort of barriers to entry for traditional funds getting into crypto on that side, or is there any sort of barriers that you'd see that maybe traditional fund managers wouldn't have considered moving in, and they might see as a problem when they do come in on that side?
Yeah, I think one of the main difference between trading crypto and trading TradFi is that a lot of things in like crypto is like very nuanced and very like specific to like crypto assets. So like things like you need to like stay on top of what's happening on Twitter. You might need to like read governance forums and stuff. A lot of those stuff, the access to information is in like ways which is not native to someone from traditional finance. And I think that's why like firms like Alameda really exceed, and newer entrants coming from like TradFi might struggle because we've been doing this for a number of years now, and a lot of us are becoming more and more crypto native. I think that's probably the main barrier.
That's interesting. Could you talk to us a little bit about that, like the process in which TradFi quants have joined Alameda and, in your own words, have become more crypto native? How has that changed the thinking, the framing, the modeling from the TradFi world?
So I guess even when you're doing analysis or like backtesting data and stuff, the pace of change in crypto and each cycle getting faster and stuff is like, yeah, I guess so apparent that if you're doing a backtesting strategy in traditional finance, looking at data which is like 2 years old is probably appropriate and makes sense a lot of times. In crypto, looking at data like 2 years old and doing any kind of strategy on that just does not make sense because the market has changed so much. So trying to understand when like regime changes have happened and why past data is no longer relevant is kind of a skill that you develop if you're very close to the crypto market and start understanding like trends, like who's trading the market now, who, like what institutions doing, at what point did institutions start coming in, what's like the retail narrative like here. And so there's so much like, I guess, coin specific stuff and like regime changes that models have to be like calibrated to like very short periods of time. So what happened in the last 2-3 weeks might be like very relevant, and then if that like trend breaks, it actually does break and just stops becoming relevant because as either being competed away is no longer true, or people have seen this and they're like doing that trade already. So things like change a lot faster. So I guess backtesting periods and stuff is different. Yeah, I think those are like the main ways in like terms of like analysis and stuff. How it's different to what I see in like TradFi.
So as you said, and Mark, did you want to dig in there?
Yeah, I was just going to ask, just due to the speed, I guess, and how crypto works, I was just wondering, like, your background, obviously you have a background in TradFi as well. So I was just wondering in terms of deploying models, would you find that you would maybe deploy a lot of models in crypto a lot faster in terms of deployment, and then you would maybe test them as they're running, as opposed to in TradFi where I guess they go through a lot more rigorous back testing, that kind of way?
Yeah, definitely. There's a lot more like, yeah, being needing to be rigorous is like a lot less of a requirement in crypto, given that I guess the edges are so big and the variance is so wide that it's quite, yeah, it's not nearly as much of a onerous requirement. Yeah, I think I agree with that. Yeah.
So how have risk limits changed between managing books in TradFi and crypto if you're essentially, testing in production, if you would?
Yeah, I think this is also like quite different in TradFi. I guess if you're a market maker in TradFi, if you can like make 1 BIP on a trade, that's like a huge fucking deal. In crypto markets, you often see ARPs of like 1% or like many percent. So edges are much larger, and sometimes like being too slow or thinking too much on something is where you lose most of your edge. So I know in like traditional finance companies, if you have like a 6-figure loss or something, that's a huge deal on a trade because you can't really afford that when your edges are so small. But in crypto markets, that's like part of the variance. So when the opportunity size is so big and like there's so much like percentage on the table, it often makes sense for the amount you bet and your risk limits also to change, and how often you're wrong to also, I guess, increase based on that. There's like, I guess there's a famous thing that like SPF used to say when he was at Alameda, which is that if you're not like making bad trades at least like some percentage of the time, you're not really doing enough trades. And I think that's like increasingly true in crypto, where you probably want, like if you're doing like delta trades or something, if you're making the correct delta decision 80% of the times, you want to keep increasing the number of trades you do until you're at like a more reasonable number of like, you're only right like 60% of the times or something. So yeah, the amount of times you want to be wrong in crypto is a lot higher than in TradFi because the times you're right, there's like so much more edge. I think that's, yeah, that's quite different.
That almost feels like a barrier to entry in itself, because like changing that mindset for TradFi traders is probably like a massive bridge.
Exactly, yeah. And even when I talk to my TradFi friends and stuff, things like yield farming, it's way too risky for them, and that's great because that's what leaves so much money in like yield farming and stuff. People are risk averse, want to be right like a high percentage of the time, whereas you only really need to be right like 55% of the times or something to like make money in these markets. So that's definitely like a source of the edge for a lot of people in crypto, that they're willing to be wrong and like bet asymmetrically.
What I find interesting is how parallel small cap trading is to the strategy you guys are describing, because it's, the joke is ape first, diligence later, because there is so much to be made in that first squeeze, that if you spend too much time thinking, you just start to lose edge so quickly. I would not have thought that. I have
Yeah,
another topic.
sometimes we also feel that like people who say that are people who have already made the trade and are encouraging other people to buy it. So for I guess yeah, it's probably like area we spend less time on. So I'm not like an authority to comment, but I would definitely like be slightly more careful when I guess aping coins of like sub like 100 mil market cap or something.
Right. I have a topic. I don't know if this is taboo or not, but we couldn't have you on without talking about it given the proximity of things. But we're really curious if you guys were trading the MIM UST DPEG, and if you weren't, if you could put yourself in a state of mind, like how does looking at something like that and a book of your size introduce, game theory elements to that type of trade? At what point is it attractive enough for you guys to step in for an ARB, and box out competition essentially?
Yeah, that makes sense. We were a bit involved in this. I guess I think so much. Yeah. So yeah, we did trade this slightly. We were in the curve pool. We ended up buying like some meme in it in the curve pool, and then we like removed some liquidity because we didn't want to buy like too much meme. I guess we're pretty comfortable with our position right now. Meme is like trading slightly lower, but meme is like fully backed. USD is USD is, I guess, they're both interesting in different ways. So meme is interesting in the sense that meme is fully backed, but it's the onus it's on like the borrowers to repay their loans, which brings meme back to the peg. But if meme is trading below $1 and the borrowers decide that they don't want to repay their loans now, the meme can like trade below like $1 for like quite a bit of time because there's no like natural mechanism to bring it back to the peg. So I think that's kind of what we're seeing right now, where like meme is trading, I think like 30 bips under or something, and borrowers are not really in like a hurry to like buy back the meme and repay their loans. The situations where this might happen is if like crypto market rally or something, then you might start seeing some more of that. Also, I guess like the curve pool has just like weird, uh, their like A level is kind of like set up in a weird way where the meme USD price is like at $1 for like until like it's very close to there being like no liquidity, and then suddenly it's not $1. So I guess that like a number is a bit yeah, I guess it's a bit weird. And I think that's probably what caused some of like this like depegging, because it was at like $1 until like very near the end. USD is also like interesting because I think USD has a lot more like game theoretical elements to it, in the sense that like meme is like fully backed. USD is backed by the confidence of people that the people who are running this and the people invested in this will, I guess, defend the peg if it does unpeg, because it's really only like backed by trust. So I think USD is like quite interesting in that sense. But yeah, I don't really have too much more to say on this because we also have like this is something we're trading and we have some positions in this as well.
Sounds good. I think you gave us enough to chew on. It actually brings up a handful of questions I'd really like to ask you about, sort of on your take in the future of DeFi. But first, something I learned when we were first speaking was the FTX venture side of things. I wasn't particularly familiar with, and I know you're involved there. And I'm wondering if you can give us some background on what's going on over there and sort of what are some of the 2022 goals for that arm, and yeah, what's happening there?
Cool, perfect. So FTX Ventures is a new venture fund set up by SPF, and we've made some like good hires, like Amy has come in, and then a couple of like people who were working at FTX and some people who were working at Alameda. So it's a $2 billion fund, one of the largest in the space, and I guess our mandate is to invest in anything which we're excited about this year and which we want to partner with, and which we want to actually like support and see doing well for like many years. So it's very different to some of the stuff that happens in trading where we are looking to make like short-term EV. This is for, I guess, the long-term investment arm of our business. Some of the stuff that we're, I guess, excited about in 2022 are things happening in the gaming space, uh, certain like layer one blockchain stuff happening, and then also, I guess, like one thing that I'm personally interested in is on the India stuff. So 2022, I would really want to spend a lot of time just thinking about India and seeing how like India can be brought to the Web3 ecosystem.
So why India? What do you see going on there that makes it such an opportunity in your eyes?
Cool. So yeah, I guess the India market is very interesting. It becomes even more interesting today because 2 days ago there was a budget announcement, and the Indian government announced that it's going to start taxing crypto transactions and crypto investments at 30%. This is quite interesting because up until now, crypto was kind of a gray area, and people were unsure if it was legal or not, and there was some like Supreme Court cases and stuff happening. So the government saying that it's going to start taxing crypto profits, it's kind of like the government saying that it doesn't consider this illegal anymore. So I think that like leaves like a huge amount of like opportunity for growth in India. And then the reason I'm probably most excited about India is like a country which is like super talent rich, but does not have a lot of capital. As a country of like 1.3 billion people, which is 4 times the size of the US. Uh, and I think like talent is like quite proportional to the number of people in a lot of sense. And I think that becomes increasingly true this decade, which is kind of like the internet decade. uh, Companies like Reliance Jio has brought millions and millions of people online for the first time, and that really allows people in India to have opportunities that didn't have before. For example, a child in Bangalore now can have the same education as someone in San Francisco because everything is almost online. Someone can park their laptop in Hyderabad and get an American quality of life because they're working for the same American tech company in New York or something. So all of this, I think, like the fact that we are moving more and more onto the internet, I think is kind of a great equalizer. And countries with a large amount of people, which byproduct is a large amount of like talent, will start like rising up more and more. I think India has been ignored for like the last like 10, 20 years in this sense. And like there's a lot of like Indian CEOs in tech. So Google, uh, Microsoft, Twitter, a lot of these are run by like CEOs from India. But previously Indian people had to like leave India and go abroad to achieve this kind of success. And I think that's really going to change with the fact that so many people are coming online and now everything's like digitized and online. And then I guess on the crypto space, I think a lot of like the natural use cases of crypto are more for countries like ascending countries, things like remittances or people not having access to like bank accounts or like ease of payments and stuff. So I think like a lot of like natural use cases for crypto will be in countries like India. And yeah, I guess yeah, those are kind of reasons. And also like India's a country which is like very hungry for like success, very hungry for tech. The government has is like very pro business now. And then compared to like countries like America, uh, I, I I just see a lot more action from the government in wanting to embrace technology rather than trying to, I guess, yeah, doing the opposite.
Yeah, I like how you phrased crypto being potentially adopted by ascending countries where there's real problems to be solved using this tech. And that sort of actually leads me right into this next question. If I had to guess from what you were just saying, it sounds like you think that the next wave of adoption, what brings more to crypto, will be a mix of builders and users. But if I rephrase that question and I ask you, what do you think 2022 brings? Is it going to be more institutional interest, more retail interest, more user interest, more developer interest, or rather, like what factors do you see playing out in each that might differentiate one from the pack? I'm quite curious to know what you think.
Yeah, sure. So yeah, between like institutional retail and user, I think one interesting phenomenon we saw in like 2020 and 2021 was that people were convinced that institutions are coming. So I guess after Saylor purchased Bitcoin and then Elon Musk purchased Bitcoin, I think the market was kind of convinced that all corporate treasuries were now going to like purchase Bitcoin, and a lot of that flow, like markets wanted to like get ahead of that flow, and a lot of like Bitcoin and stuff was bought on leverage. When that flow didn't really happen, we saw a lot of these like ugly liquidations we saw at like the May of 2020. Uh, I think similarly, when like I guess El Salvador made Bitcoin a legal tender, we saw like a lot more people thinking that like all of this adoption is like tomorrow, which really wasn't the case. I think institutional money hasn't really like entered in the last few months. Saying that, I think 2022 is probably the year we finally start seeing a lot more institutional adoption of crypto. I think that also becomes true because of some of like the favorable regulatory stuff happening. Uh, Exchanges are like FTX and stuff are trying to like onboard like more institutions. So on like the institutional side, for 2022, especially like later half of 2022, I'm quite like bullish on like institutions coming. On retail and user adoption, I think retail adoption, I don't really have a strong opinion on if we're going to see the same amount of like retail adoption for trading cryptocurrency that we saw in 2020 and 2021. There are some arguments that this is like a continued trend, and I guess gamified finance and all of that, and people are going to like continue wanting to trade on like on their like FTX app or their Robinhood app. Uh, I'm also not really sure because COVID is over. People might want to like get out and not really want to spend as much time locked in. They not have like as much like discretionary income once they start spending stuff on like real world assets. Like so on that front, I don't really have a strong opinion on. User adoption, I think, is key, and that's the part that I'm like most excited about. Uh, of like people building stuff that like people can actually use. I think we are yet to see some like crypto app which has like mass user adoption. I'm not really sure where it's going to be. Maybe in the gaming space or something like that. But uh, I'm hopeful that like in 2022 we might see like a lot more user adoption than we have so far.
Yeah, I almost fear it's a bit of a unfair question I asked you, because it seems that the market as a large at large has really been split into its own separate verticals. And obviously we saw retail hit fever with the meme coin phase of the bull market. And now, if you look at performance of the most recent Coinbase listings, they haven't been quite exciting, which in my opinion is a very good proxy to understand whether or not retail is here ready to buy anything that lists. But at the same time, it appears that NFT interest remains. And even when you speak to a lot of NFT founders, they're non-technical founders. So there's a new wave of retail that's come in, and that market seems to be sustaining, although it may not be unsustained. It may not be sustainable in the long term. And then similarly, I agree with you. Gaming, GameFi. It seems that there's potential to see separate trends in GameFi and NFTs from the token-specific speculation side of things. So I almost fear that this market, or fear is not the right word, but I almost think that this market is now finally hitting that scale where we can't just call it the market anymore. It's really starting to bifurcate. But I did have another question for you, and I want to start getting us towards the topic of DeFi, because I do have questions there, specifically around Serum and some other things. But before we get there, VE33, right? The V token meta narrative just hit fever pitch. It dare I say, blew up in a spectacular fashion. What do you think? Bright future ahead of it? Is it going to see adoption and tweaking, or was it like relatively, not half baked, but were there unintended consequences to that model that ended up playing out?
Yeah, I think this is a very interesting one. And I think this is something that like I think we might even start seeing in like I guess the TradFi world as well. So I guess the main argument for the V token model is that you encourage users to lock up tokens, and locked tokens can't be sold. And if you like decrease sell pressure, then that has like I guess a positive impact on price. The other I think like deeper thing is that you're also like aligning you your like holder base. So if I'm holding a token, then in a lot of sense I might be like a mercenary. But if I'm willing to like lock up my token for a very long time, then my interests are like very aligned with the project. So you start like filtering out for people who are like longer term believers of your project, which I think is quite interesting. And I've like thought and had some discussions with people about like what if like this kind of stuff start happening in the TradFi world with like stocks and stuff. I think the other thing is that so a lot of like crypto is driven by like narratives and attention. So when someone decides to like lock up their token in one of these V models, what they're saying is that my attention is on this coin right now, and I'm happy to give up the optionality uh, for it in return for something. So if you think that the market has like short-term attention, and does not like value optionality, then like totally makes sense for like protocols and stuff to like encourage these kind of like relocking mechanisms, because whatever is hot right now people will buy, and because their attention is on that they might like lock it up, foregoing the optionality which they might like regret later. So I think that like that kind of like stuff is like quite interesting depending on like what they think the users are valuing, what they think the holders are valuing. I think the stuff built on top of it like concave and stuff is also interesting, because a lot of these like tokens are like governance tokens, but individuals don't have like a very strong, I guess, way to like influence governance, but as a collective you have like a much stronger way to like, I guess, influence. So I guess the examples would be like there's a lot of tech products right now that we all use that has like millions of users, and these tech products like monetize these users and then like are worth like billions of dollars, but the users of these like projects don't really, I guess, get the same benefit that these tech companies do. And if some other project came and they left, then uh, the original like project would like have a huge loss. So that's why we see things like liquidity mining and stuff. But which makes me think that what if like users could like collectively come together and like bargain between like project A and project B that hey, if you like reduce fees, or if you uh, do like XYZ, or if you start like sharing the billions of dollars that you're worth with your users, then we'll use like project A, otherwise you're going to move to like project B. So I've thought a bit about like those kind of stuff, and I think like some of like the curve wars and stuff is like really interesting and has like a lot of like parallels to like real world, where we might see things like groups coming together with like governance and saying that hey, we're going to use like the projects which like reward the users the most and stuff. So yeah, I think it's like a developing idea, and I'm quite excited to see like where it ends up.
Yeah, I think you highlighted a really strong point here, and I'm going to phrase it slightly differently, and that is that tokens are social coordination tools, and the more tooling we have that creates deeper levels of coordination, um, the effects of that are not yet known, right? And the ability to coordinate over very large pools of capital, over a very large group of shared interests, has just really never been pulled off at this scale, if you think about it, right? And you just think about the evolution of how societies and cities and populations have grown. They just keep getting bigger and bigger and bigger. And then the internet hit, but we never really had a way to coordinate at that scale. And something like VE, I think, really just starts to scratch the surface of that. So I think, it probably got a lot of flack given recent price action, but I agree with you. It is quite interesting. Um, that brings us right into sort of the future of DeFi, right? What do you think about its current state? Obviously, there's a lot of good and bad around current inflationary models. I guess I have to ask you, how does Serum fit into your vision of DeFi? What's exciting you right now?
Cool, perfect. So yeah, again, like DeFi is something we spend a lot of time thinking about, and like a lot of like Serum was built by ex Alameda people, and Alameda like definitely played a big part in like at least early Serum, even though we don't have as much a part now. So I guess like some of the stuff that we think about in DeFi is that there's very few DeFi projects which actually have been able to like gain users without token incentives or like continuous customer acquisition costs. Uh, so all of these projects are like printing money and giving to users, and that's why they use it. Which makes me think that like without these like continuous incentives, how many people would be using like DeFi in the current state that it's in? There are some analogies to like, I guess, the traditional world where Amazon and stuff were happy to run at a loss for many years to acquire users and grow. But yeah, it seems like in the DeFi space, a lot of projects just have no like exit from it. They just have this suboptimal way of true liquidity mining of gaining users, and they're not really trying to like maximize or do any like calculation on how much they need to give out for these like user acquisition costs. So in that sense, like that kind of like DeFi is like not super exciting for me. Also, I guess coming from like a market making background and stuff, like AMMs in general, uh, sometimes like surprises me, because people providing in these pools are providing stale offers. It's like providing an order book, but your offers are stale. you get like rewarded pretty high fees, so like 30 bips or 25 bips between like Uniswap and SushiSwap for providing in these pools. But again, like it makes me like wonder how much of those liquidity would be there without token incentives, and once those token incentives run out, would that liquidity still be there? So for like the majority of DeFi, that's my like current view on it. And I think there are some exceptions, some stuff that we have seen which have worked, some stuff which have also like got I guess user traction without incentives. I guess some of the stuff that are like structured products which are like selling call options and calling them, yeah, selling call options. Those protocols have got some like traction without any incentives. But again, I think people are sometimes like misunderstanding that this is not the yield that they're earning, and they're just selling the upside tail of holding this coin and like making a lot of money. That kind of makes sense if you like log wealth and you're okay to sacrifice like huge amount of gains for like less money because of your like utility preference. But the stuff in like DeFi that excites me is things where you can take stuff in the TradFi world and do it on like a decentralized way. So things like Serum. Serum is like an order book. It looks and like feels like FTX, but it sits on the Solana blockchain. There has not been any like token incentives on Serum, but if someone wants to trade on the decentralized order book, they can go on Serum and use one of the front ends and trade on it. And I think like trying to build actual stuff that people have used in TradFi and found useful, and building that in DeFi, I find like very like exciting. I'm also like excited about like people using stuff on DeFi without really understanding that they're using the blockchain, or without like, so where I guess the blockchain and DeFi become like the backend for a lot of like the stuff that we use on day to day. Maybe that's like payments, or maybe that's like saving tools and stuff. But I guess blockchain and DeFi is like a better like backend to some of the legacy backends we have in like the banking system and stuff. So I'm excited about like that kind of stuff. But I think like DeFi still has like a long way to go to get to the vision of like 1 billion people using DeFi or something.
Oh, for sure. Sorry, Matt. You were just talking there about like porting TradFi to DeFi, and I think one of the projects I was kind of most excited about fundamentally last year was Oxy. I know maybe it hasn't got the best press recently, but in terms of the actual project, like basically prime brokerage is probably the ideal industry to port from TradFi to DeFi because it's such a massive, lucrative industry and it hasn't really been disrupted in like, well, since its inception. So I think that's like, those kind of really, really lucrative industries for banking are like ideal candidates to port over onto stuff like Solana, I think.
Yeah, definitely. I agree with that.
I have a question for you. In 15 years' time, what percent of user deposits do you think are held in peer-to-peer DeFi applications versus institutional banks?
I would probably buy 50%.
Yeah.
So I think, yeah. I think like under collateralized stuff is probably going to be also like quite interesting when it comes to DeFi. Like most of like the real world happens like under collateralized. So things like, oh, I can borrow money, but I have to collateralize that by like 150% of some other asset. It's a lot less exciting than where I can like lend to some trusted third party, and it's like under collateralized loans. So things like what Maple are doing, I find like will also increase the amount of like TVL in these kind of projects.
Can you talk to us a little bit about Maple? What you think?
So I guess Maple have this like system where they have like KYC some people, and there's some like, kind of like legal agreement. Alameda are like a borrower in some of these pools, and then people who are also KYC'd can decide to lend Alameda money through Maple Finance. And I think there's like a lot of appetite for people to earn yield, and there's also a lot of appetite for people to borrow. But the fact that like most of the borrowing in DeFi right now happens through like over collateralized stuff means that the amount of borrowing that happening is like a lot smaller. I think if we want like loans, total loan size to be over like 100 billion and stuff, most of that would need to be like under collateralized.
Interesting. I'm going to move us into the third phase of our space today. These start to become much less focused, but what advice do you have for the crypto degens who are still in this space, who still want to trade, and are going to be trading over these next few months between now and the March FOMC?
I think one thing we're seeing is that the markets are becoming a lot more competitive. Uh, like 2-3 years ago, if I told my like friends from like Susquehanna about crypto, they would have thought that it was like dumb and stupid. But now I think a lot of people are like realizing that that's not the case, and like crypto does have a future. So competition, I think, is going to like increase in the space, and competition increasing means that maybe the total amount of money to be made in crypto uh, goes up because there's more volume and stuff. But people might find like harder and harder to, I guess, make a lot of money on their like edges. Uh, I think like some of like the golden period of crypto trading is probably like going to decrease in 2022. But I think on the other side, like the golden period of like building stuff and like racing and like building applications that like millions and even like a billion people will use, all of that is definitely on like the up and towards the right. So one of the advices I have is like if you're in like a bull market, definitely like keep trading and stuff. But if the markets do calm down, I definitely would advise people to like get involved in the space from like a building and like, and even if you're not like a programmer or something, there's other ways you can like join crypto projects and contribute. So that's something I'd be like give us an advice for like crypto degens.
Yeah, it's not too dissimilar from 2018, 2019, when we blew off and everybody was essentially trading, perps on BitMEX. It became insanely competitive. And it just became, who was the biggest shark, made the most money, and most people lost. So maybe perhaps your advice tells us a bit about where we might be in the cycle. But it sounds like, macro could still be playing a big role in just how long we're in that portion.
Yeah, that's right. Yeah.
So I wanted to open up some questions to the audience, but I'm being honest here, and I've never hosted one of these spaces, and I'm not sure how to get questions from the audience.
I don't know either. I haven't done this.
Yeah, I thought there was a raise hand feature. So unfortunately, it looks like we may not be able to do that until we learn for next time. But before I do sign off here, Aravind, is there anything that I didn't ask you about that's been really pressing front of mind, something you've been wanting to talk about, or a message you want? Oh, wait, here we go. We have a requested. Okay, so maybe we do have questions here. Let's hold on there for a sec.
Yeah.
Add as speaker. All right. Welcome, Professor.
Thanks. Hey, you just hit the request. You have people hit the request button, then people can join in when you click the green check mark for questions.
Cool. Perfect.
Okay, in that case, we'll open it up to some questions. So if anybody would like to request to come up here and ask anything of Aravind, I'll give you all a minute or so to do so. And if nobody has any questions, I'll be actually quite disappointed. Too many smart brains in one room to not have any questions. All right, Leezy 3000 is connecting. Welcome, Leezy. I think you are muted.
Hello.
Hey.
Hi. So my question was, how is your sort of long-term approach in the multi-chain sort of aspect of things? Or is Alameda sort of like, I know they're very long Sol in general, but how do they view the approach on like layer 2 specifically off of ETH?
So yeah, we're definitely like very bullish Solana, and we're big investors of Solana. We also think there are like other blockchains which are like doing some very cool stuff. The layer 2 space is something I've been like watching a bit. I think like it's almost like a lazy way to like scale a blockchain. It's like a layer 2. Uh, like a lot of people think that like layer 2 and stuff is like specific to ETH, but any blockchain can have a layer 2. So Solana can like have a layer 2. Any of the other like blockchains can have a layer 2. I was quite like excited by Ethereum's like earlier visions of like, I guess, Ethereum 2.0 and trying to like fix their like scalability issues and stuff. And the layer 2 argument makes me kind of feel like they've given up on that, which is a bit disappointing. But we're like definitely like watching the space. There's a lot of like interesting like layer 2s, and I think there will be some kind of like a layer 2 war where that space will like heat up, and we might see something similar to like the layer 1 wars in like last year. The other stuff that's like I guess people are talking about is CK rollups coming onto Ethereum. That's something that a lot of like smart people I've spoken to are also like excited about, and a lot of like other smart people I've spoken to think that like general purpose CK rollups are like many years away, and given like how slow Ethereum has been like the last few years to like ship things, that's probably the argument I feel is like more likely. And I think all of this probably leaves us with the Solana being like the only blockchain which like can scale to like millions of transactions per second, and like that's possible over like the next 1 or 2 years. So if DeFi does, like people do believe that DeFi is going to kick off, and it does kick off in the next 1 or 2 years, I think it's most likely to be on Solana. If that's not the case and DeFi takes like longer time for people to like actually have like a desire and demand for it, I think the space is very open, and it could also just be like a blockchain that's not here and doesn't have to be like an Ethereum layer 2.
Awesome. Thank you, Lizzie. I'm going to go ahead and add our next question. And he is connecting. Welcome. Go ahead and unmute yourself.
Hey, question for me is regarding NFTs. I know FTX is offering an NFT marketplace, but how does Alameda look at the market potential of NFTs?
So right now, we're not like very involved in the NFT space, and one of the reasons for that is that NFT is like quite exciting for a lot of people who are like using it and trading it and stuff. But as a market making firm, the NFT liquidity is a lot smaller than, I guess, liquidity of like many of these tokens. So the amount of like edge and like the amount of money there is also like a lot smaller. Also, I guess like NFTs are not like homogeneous. It requires a lot of effort to like price each individual NFT, and a lot of times there's like liquidity premiums and stuff. So it's not a space that we're like very involved in. Yeah. We're also like from the venture side though, we're quite excited about like NFT projects and like projects in the gaming space. And NFT seems to be one of those like areas which has gained a lot of like user adoption without any like continuous customer acquisition cost or yield farming or like token incentives and stuff. So it does seem like it's the first time that there has been like a huge like natural fit for a crypto product and the masses. So in that sense, we're excited to like invest in projects, but not on the trading side.
Awesome. Do we have any other questions here? Okay. Aravind, is there anything we didn't cover that you want to talk to? If not, I got a story to end this with, but I want to make sure you have a chance to share anything else.
Yeah, nothing else on my end. So excited for your story.
So yeah, while hosting this here, I happened to be at an Airbnb near a beach, and I got here today just before the space, and I got onto the internet and started hosting this. And in the middle of this space, a stranger walked into the front door, unplugged the Wi-Fi router, and just took it with him and walked out. So luckily, my cell phone switched over to 5G, but that was an unexpected halftime. So thank you for just being an awesome guest and keeping the conversation going during that.
Oh wow, that's pretty crazy.
The whole thing could have shut down because I was DCing as well, so there'd be no hosts left and you'd be gone.
Right.
Well, anyway, Thank you, Aravind, so much for joining us. Mark, thank you for co-hosting this as well. For everyone who asked questions, thank you so much for your time. Go ahead, follow InternDAO, subscribe for notifications so that you know when we're going to be doing our next spaces. We have an awesome lineup of awesome speakers that are going to be coming down the pipeline, perhaps once a week, if not more. If you have any guests that you want to mention, feel free to DM. If InternDAO is something interesting to you, the application process is through our Twitter DMs as well. We have a admissions committee that meets bi-monthly to add alpha generating degens to the group. So with that, thank you everybody for your time this evening, and wish you all a great night or day. GM.
Thank you so much for having me, and excited for your next podcast.
Cheers, Aravind. Good to speak to you again. And thanks, Matt, for hosting as well.
Thank you.
Bye.